Hi, we're working on chapter 12, and we're talking about another way organizations raise cash. One way is through issuing stock, which we talked about in chapter 11. And this chapter, they're issuing bonds and notes. So they're having a liability instead of an equity account. And of course, along with liabilities like bonds and notes, there's going to be some interest expense. So we're going to talk about that. You still calculate it the same way as always, but we'll talk about it as we get to that. So let's just jump right in. We're doing exercise 12-5 from the book. 12-5 is entries for issuing bonds. So issuing bonds means the organization wants to raise some cash, and they put out these bonds that are liabilities. And so people purchase the bonds from the company, give them cash in exchange, and the company gets to use the cash, and the people hold on to the bonds, and they get paid interest on a regular basis, and then they can trade the bonds in for the face amount at some point when they mature. So let's look at this. This company issues $7.5 million 15-year 10% bonds on April 1st at face value, so that means they got $7.5 million in, with interest payable on April 1 and October 1. So every 6 months is pretty common actually for bonds, is they pay semi-annually. Fiscal year of the company is the calendar year, so they're telling you, January 1st through December 31st. Journalize the entries to record the following selected transaction. On April 1, issued the bonds for cash at their face. October 1, paid the interest on the bonds, so 6 months later, paid the interest. December 31, recorded the accrued interest for the 3 months. So there is an accrual, not paying the interest, but we're going to accrue it. All right, so let's just do those 3 transactions. Issued the bonds for cash at their face amount, so that's $7.5 million, right? So that's an easy one. We just get that cash in, and that was on April 1. Right, of course, cash in is always a debit, right? And it becomes bonds payable. It's a liability, right? So bonds payable. There we go. There we did. We paid that. All right, paid the interest on the bonds. So 6 months have gone by. Every 6 months, they're going to pay 10% interest out to the people, just the interest. All right, so we have to calculate that. Principal times rate times time, right? So I'll just do that real quickly here. Principal times the rate times the time is equal to $7,500,000 times the rate, which is 10%, and it's half a year, so we'll just times that times 0.5, but of course it would be the same thing as 180 divided by 360, right? It's half a year. All right, so principal times rate times time, 7.5 million times 10% is 750,000. Half of that is 375,000. All right, so that's interest expense, right? So our interest, so 10.1 interest expense. So expenses are, when we increase them, are always debits. 375,000, and we're paying it out in cash, so that's some cash going out. When cash goes out, that's always a credit. There, paid interest, easy peasy. Final thing, recorded accrued interest for 3 months. All right, so 90 days or 3 months. So that can either be 3 divided by 12 or 90 divided by 360. They're the exact same thing. All right, so we're just accruing the interest. We're not paying it, right? So it's a liability. Remember the thing about accruals. We look around at the end of the period. We say, what do we owe to people that we haven't paid? And we accrue it. So in this case, we owe 3 months of interest for those bonds. We want to match it to this period. So we're going to accrue it and call that an interest payable. All right, so principal times the rate times the time is still $7,500,000. We haven't paid any of the principal back. It's still 10%. This time it's time 3/12 or 190 divided by 360, however you want to look at that. All right, a quarter times 0.25. All right, however you want to look at that. So instead of 375, the interest for or you can say it this way, if this is 6 months worth of interest, 3 months is half of that, or 187,500. All right, so on 12/31, our entry is interest expense, of course, that's what we're calculating, right? Interest expense and interest payable. Right, 187.5 and 187.5. All right, and we did it. That's exercise 12.5. Got the cash in, paid 6 months worth of interest, accrued, but not paid, accrued 3 months worth of interest. And that's all it's asking us to do. At some point in the far distant future, we would have to repay those bonds, but that's not now. All right, great. Next video, we'll be moving on to exercise 12-9.